Welcome to the Rosenberg Roundup. I'm Dylan Smith.
And I'm Jacob Rosenberg. We're recording not long after the release of U.S. CPI, so that will of course be the main feature of today's episode. But Dylan, what else do we have on the docket?
Well, yeah, we'll get into CPI for sure. We'll also check in on the week that was in markets. Related to the CPI data, Fed Chairman Jay Powell was giving some testimony on the Hill this week, which is important, so we'll cover that too. We'll check in with European politics and a quick view on what to expect in the data front next week before we get to our Spotlight section, which will be on earnings season.
Sounds great to me. Let's get started with the week in review. Okay, let's start at the top with US CPI. What's your take?
Yeah, so we're chatting shortly after we got the CPI data in. And what we saw were the first hints of some outright deflation since 2021. So a very soft number coming in. We saw the headline index fall by 0.1% month on month, and the core index up just a touch, both of them coming in much weaker consensus. So the overall picture here is a surprisingly low and soft print on inflation. That's now the second or third in a row after we opened the year with some hotter than expected inflation numbers. So trending very much in the right direction there. And the really good news was we've all been waiting for rental inflation to settle down, and we saw more evidence of that in this report, where we had rental inflation up only 0.3% month on month. Still fairly high and still higher than the average of the entire basket, but looks like the days of the 0.5% to 1% monthly increases in rents are behind us. And as we've talked about on this podcast many times before, the trend there is down. That's going to help pull overall inflation back to target. So everything moving in the right direction here from the Fed standpoint. If this doesn't give Powell confidence and get him closer to the confidence he needs to start cutting, not sure what will, but we'll touch on that a little later, I think.
What else did we see on the data front, though?
Well, we didn't learn too much about the economy this week, aside from that, inflation was a bit softer than people thought in June. It was very light data flow. It didn't stop the markets, though. It was all about momentum, and in the absence of any information in a momentum-based market, the only way to go is up. In fact, the S&P 500 has now managed its longest string of highs since 2021. So, no news is good news from an equities perspective. Other things notable this week, we saw the commodity complex, probably the worst performer in global markets so far. Aggregate indices on all commodity prices down around almost 2%. We saw, oil take a bit of a hit this week, along with copper and gold. Although don't forget, we still love gold from a more medium-term perspective, and we're very interested as well in the gold mining stocks, which look a bit underappreciated. But overall, the song remains pretty much the same this week on markets. It's going to take something else to shift it from that momentum-based bull market we're seeing.
We saw a lot of Powell this week on the television screen. Maybe you can take a moment just to break down some of the statements that he had to share over the past week.
Yeah, so you'd be talking about the semi-annual testimony to Congress that the Fed chair is obliged to give. And, what this really should be is a chance to kind of take a real deep dive into how the Fed sees the economy, what its kind of intellectual framework is for how it's reading the economy, and therefore how it's setting rates and its monetary policy strategy. And historically, we've seen these types of testimonies be much watched because they're big market movers. Powell essentially used this statement basically just to provide a very near-term update on how the committee is thinking about rate moves in relation to incoming data. So the overall message that markets took away, which, they couldn't have taken any other message because Powell just said it pretty much straight up, was that, they're getting close to a rate cut, but July's too soon. But the labor market's softening a bit, and now we have inflation softening as well. So September very much in play. And of course, market odds for September are pretty strongly in favor of a rate cut. So that's where everything's kind of lining up.
I was there when we had the testimony playing on the television screen at our office. And I can tell you firsthand, it seemed like our reaction from the team seems like the general consensus was that the testimony was pretty disappointing. But maybe you can break down for our listeners why we had that general feeling of disappointment.
Yeah, well, I mean, you were privy there to what gets economists worked up. And really, I think there was a bit of disappointment in the room about the lack of depth we were seeing from Chairman Powell. So under Powell, these sort of events and most of the speaking engagements he has have really just become a recounting of the data, right? This went up, this went down, what you can get in the newspapers. Whereas before, from previous Fed chairs, you'd get a really deep analysis of, beyond the kind of data flow, which we know there's problems with. We know they get resolved. We know they lag. And we know they get revised rather. So, you can't just report that and say that therefore, interest rates will go up or down. Like you need a framework to look at the economy with. You need to be actually an intellectual leader, right? You're running the most important central bank in the world. You can't be providing a Wall Street Journal level analysis of what's happening in the economy. So that's kind of what gets our backs up a little bit. And we actually published a comparison. We just pulled a couple of random Bernanke, Greenspan testimonies from before and just sort of showed the difference in the level of analysis taking place. And this is important because there's real risk building up of policy errors if you're not following a sensible framework, right? So maybe we got something at the Jackson Hole conference in August that's a bit deeper, but really the markets are kind of it's just so simple. Data comes in up or down. We know that just directly affects how the Fed thinks about things. There's no longer term narrative in how they're working. There's no structural way to interpret it, and so markets just react directly. And if you want a comparison, on Wednesday, the chief economist of the Bank of England, Hugh Pill, who happens to be my old boss and mentor, made a very long and complex speech on exactly the opposite premise that Powell's talking about. So he was saying, data flow can be very patchy, can be very unreliable. And the whole speech was about how do policymakers actually deal with that challenge? How do they look through that and still get things right and still spot the bits of the data that are actually giving them a really strong signal? So yeah, that should hopefully explain it. And we hope that the Fed can start taking a leaf out of the book of its colleagues across the pond.
It seems like a good time for us to share a quick word about our sponsor, Kalshi, which is the first and only CFTC-approved financial exchange that helps you trade directly on economic data. Yeah, it is good timing because Kalshi offers a contract on the Fed cutting by September, which is what we were just talking about. It's a very simple binary contract system. So if you think the Fed will cut by September, so that's either in the July meeting or the September meeting, you can buy as many contracts as you like, which last time I checked were priced at 69 cents. So if you're right, you return with $1 on each of those contracts, which is more than a 50% return. If you're wrong, well, too bad. Follow the link in our show notes to start trading today, and Kalshi will give you $20 free credit to get you going. So Dylan, we've already covered the Fed outlook, so let's move on to something else. Let's move on to politics, which is a topic that's continued to be a worthy point of discussion, especially when we're considering the global macro landscape these days. Yeah, that's right. So, I think there's a lot of headlines still dominated by the U.S. and the kind of psychodrama in the Democratic Party about whether or not Biden should continue. No news, actually, since we last spoke. He's dug his heels in. People are starting to think through the implications of what a Trump sweep and the down-ballot support on congressional voting would look like. So I think that's where the market is thinking. But, a lot could still happen, and that remains a live story. But the big news is more what's happened in Europe. So we had the UK election on the 4th. That has delivered a much more stable political and economic setup, we think, than the outgoing government. We've got a very strong, in terms of their control over parliament, centrist to center-left government in place. They have been very on message in terms of reaching out to the business community just after they were elected. Everyone from Keir Starmer down has been making very positive noises in terms of wanting to kickstart economic growth, work hand in hand with business to get that done. And it's been reflected on some real things too. The appointments in most of the cabinet positions have been, I think will please people in the market. It's very technocratic. A lot of people coming from the private sector or with very, very strong expertise in the portfolios that they're going to run. And so a huge mandate there, which they are pursuing towards a growth-oriented policy and reform agenda. We'll get more information next week in the King's speech on exactly how that shapes out. But, from a market point of view, very positive developments there. And we've seen that reflected in a big appreciation in the pound.
By contrast, just across the pond from them, France can be best summarized by, a massive increase in the level of uncertainty surrounding French politics and policy. We've ended up with the right being pushed into third place after the second round of voting. But what that's meant is that there's no clear center of power. We have the most seats in parliament held by the coalition of the left, which ranges from everyone from the sort of sensible center left through to like actual Trotskyites. We also have the Macron-aligned center with the second most seats in parliament. So now we're in a period of trying to work out how the balance of power between the center through to the far left actually falls, and what that means for being able to, pass budgets and pass policy. And really no one has a clear grip on that right now. And so you're seeing a lot of negative sentiment to France, justifiably. They can't do anything about that parliament for a year under French law. So we're stuck for a while with this position of the president not having a majority in parliament and kind of chaos around what the actual government agenda is going to be for some time. So in a very rapid reversal of the post-Brexit dynamics, we're seeing the UK outlook strong and stable, and we're seeing the French outlook very chaotic right now, and that obviously has ramifications into the rest of Europe and how the ECB thinks about rates, etc.
So let's turn ahead to the coming week. What do we have to look forward to, Dylan?
Yeah, so just sticking to that politics theme, we do have announcements coming in the King's speech on the 17th in terms of what the UK government specifically is planning to do for the next year. We'll probably get some information there on when we can expect the next UK budget and a few of the key fiscal policy programs that they'll be looking at. Meanwhile, in France, it's just going to be noise, basically, as the messy negotiations between the different factions continue. And probably a big weekend for the Democrats in the U.S. Biden's kind of on a bit of a breather with the NATO summit at the end of this week, but everything I think will come to a head a little bit more over the weekend and next week, so keep an eye on that.
Okay, so maybe we should talk a bit about the data front then.
So I think we'll learn a lot about U.S. activity next week. This week was prices, next week's activity. We have a big round of information coming for June, which of course is the last month of Q2. So all the Q2 nowcasts will sort of be almost finalizing their views on Q2 GDP. So just later today, actually Friday, we'll have the UMISH sentiment index coming out. But next week we have retail sales on Tuesday. Market's actually positioned for another slight reduction in retail sales there. They'll be followed by IP on Wednesday. We have housing market data coming throughout the week. So the NAHB index, we've got starts data, we've got permits data. And then we'll get the Beige Book as well next week. That's the narrative report from the regional Fed networks, which is a key input into the Fed's meeting later this month.
Anything else that you're looking out for in the week ahead?
Well, you've given me a little window there to make a very cheap substitute for our Canada Corner feature, which is just to point out that we do have Canada CPI data next week, and the following week will be the Bank of Canada's rate meeting. So pretty important print there. What we've seen lately in Canada is that we got last week a very, very weak job markets report, surprise contraction in employment, the unemployment rate up 0.2 percentage points, broad underlying weakness emerging in the labor market there, hours down, the only blip being a slight increase in wages, but which can be explained more by the drop in hours than an increase in pay packets. So, a lot of information from the labor market saying that the bank shouldn't be shy on pursuing a steady decline in interest rates after starting cuts last meeting. They should continue this meeting. They'll also get the Business and Consumer Outlook survey, which they take quite seriously. So overall, the case for cuts remains strong, and we're hoping next week's CPI print strengthens that case so that we can have another rate cut.
So let's move on to today's research spotlight, which, as a reminder for our listeners, is just our opportunity to take a Rosenberg research report that we published recently and shine a bit of a spotlight on it for anybody who might be interested. Dylan, I understand that this week we've selected a piece on earnings season.
Yeah, very timely. Our colleague Bhavana Chabra did some work on what to expect this coming earnings season, Q2. Feels to me like it's always earnings season, but we are getting into it with the banks upcoming, and then a few weeks of earnings landing every morning and evening. So I think the most interesting thing about Bhavna's piece was she started off by just pointing out that we've been talking a lot about concentration in equity markets, and especially in the S&P 500 index. When we look at these indices, it's really just a few stocks moving the headline around. But she made the point that that's actually a fundamental thing in earnings too, right? So markets are expecting 11% profit growth in this earnings season. They're expecting profits to rise 75% on the year for the Mag 7, but only 3.5% for the rest of the index, right? Which is basically just keeping pace with annual inflation. So in real terms, actually basically no improvement in earnings. There's polarization all over in other metrics too. For instance, margins are expected to expand by 815 points for the Mag 7 and contract by 74 for the rest. Revisions have pushed earnings expectations up 3.2% for the Mag 7. They've gone down minus 3.2 for the rest of the index. So we're seeing this divergence between these supercharged tech stocks and the rest of the market, also reflected in actual earnings, not just prices.
Right. And I think she also dug deeper, Bhavna did, into the sector level. So maybe you can give us a little insight into what her findings were there.
Yeah, that's right. I mean, Bhavna's in a hot position as a senior strategist at the moment because those market dynamics make it very difficult to make good recommendations on actually where to allocate within the equities market. But she's found some real gems, which I think we should pay close attention to this earnings season. So one thing she really likes is communication services. That's received some big upgrades actually in earnings expectations recently, but it's still one of our top picks, and we'll be watching that one closely. Commodities have actually had their earnings expectations trimmed quite a lot of late, but we remain pretty bullish on commodity prices generally. In fact, we describe ourselves as commodity bulls. So we would see any disappointments there or any underperformance as a chance to pick up some potential value, because we think that's going to outperform going forward. The other sector where we're seeing similar dynamics are utilities, where there have been very big expectations priced in for earnings. That sets them up for a potential miss, which I think would lead them to being punished a little bit on the price front. We would pick those up. We're also long-term bullish on utilities. Sectors where we are a little bit more nervous and probably would shy away from include industrials and healthcare, where there have been a spate of downward revisions, and we've seen pretty weak performance there, especially anything a little more exposed to interest rates and the consumer. And then on consumer discretionary, pretty mixed. Obviously, on the one hand, there's a slowing consumer that benefits some parts of consumer discretionary spending, and obviously consumer staples as well. But there could be some tailwinds if Fed rate cut expectations really get priced in a little bit more. So that's a trickier one where you need a strong macro view, I think, to make a big play.
And with that, I think it's time to wrap up. Thanks as always to those who listened to the end. And if you enjoyed what you heard, make sure to leave us a review, and you can send us any feedback you might have to information@rosenbergresearch.com.
Thanks for joining me again, Jacob. Always good to have you keeping me on topic. With that, I'm Dylan Smith, you're Jacob Rosenberg, and that was the Rosenberg Roundup.